Welcome to the Deep Dive. Our mission today is to really get under the hood of the Concentrix Q4 earnings call.
Yep, ticker CNXC.
Right. And what's fascinating here isn't just the numbers, but the market reaction. The stock rallied pretty hard, actually, despite some headlines that looked, well, awful.
They looked terrifying.
So our goal is to find those specific nuggets in the call that explain why investors were buying, not, running for the hills.
And I think this is just a crucial deep dive because Concentrix is at this huge inflection point. It's been slogging through this massive integration post-Webhelp.
You're right.
And this is all happening while the whole customer experience industry, the CX space, is being totally shaken up by AI. So this call was a real checkpoint.
An execution checkpoint, you mean?
Exactly. Can management turn all that scale they bought into real, durable profit and cash, especially with AI changing everything? For you listening, this is where we find out if their pivot is actually, working.
Let's dive right in with the numbers, because this is where the main conflict of the story is. The divergence between operations and the accounting. Operationally, it looked pretty solid. Non-GAAP EPS came in at $2.95. That beat consensus of $2.91.
A 4-cent beat. Not huge, but solid.
And revenue, $2.55 billion. Also a modest beat, maybe $10 million or so. Year-over-year growth of 1.3%. So far, so good. Right.
All's the fun. And then you see the GAAP number, and it just stops you cold.
Yeah, let's not bury the lead. They reported a GAAP EPS loss of, negative $9.98 per share.
A massive loss. I mean, if you just saw that headline, you'd think the company was imploding.
And this is where we really need to pause and explain it, because almost $10 is not a small miss. What on earth drove that giant red number?
It was almost entirely one single thing. A huge non-cash $1.52 billion goodwill impairment charge.
Okay, let's break that down. Goodwill impairment, what does that actually mean?
To put it simply, when you buy a company for more than its physical assets are worth, that extra bit is called goodwill. It's an asset on your books.
An intangible asset.
Exactly. And if your stock price falls or the market changes, accounting rules say you have to impair it or write it down. This charge is basically them saying the value of the Webhelp assets on their books is lower now, mostly because their stock has been trading low.
So it's backward looking, it's not cash that left the building, and it's driven by stock valuation, not how the business actually performed in the last 90 days.
Precisely. And the market, the smart money, they look straight past that. They focus on the real operational proof points.
Which were?
Non-GAAP operating margin hitting 15.3%. That shows fantastic cost control. And, maybe more importantly, adjusted free cash flow of $241 million in one quarter.
That's the real health indicator.
Cash. That's the health indicator. So that strong operational quarter, combined with how management framed their strategy, it just completely explains the rally. Expectations were on the floor, and they delivered where it mattered.
Right. The narrative shifted from accounting disaster to operational execution.
Exactly. And that execution is all about their strategic shift. They spent a lot of time on the call laying out 4 key actions to become what they call an intelligent transformation partner.
Which is code for moving away from being just a call center.
It is. So action 1 is that high value focus. And it sounds like they're really doing it. They're getting rid of the low end stuff.
Oh, so?
They successfully cut the amount of non-complex, low-value work from 7% of revenue down to just 5%.
Okay, so a 2% shift.
But here's the key detail. They didn't just fire those clients. Most of that reduction came from using their own internal automation tools to do the work. They basically automated themselves out of a job, proving the tech works.
That's a huge proof of concept, which should lead right into the second action, growing wallet share with existing clients.
It does, and the numbers back it up. They saw a 9% increase in new business wins year over year.
Okay.
But the really interesting number, the one that drives margins, is the 23% increase in cross-sell and upsell deals. Clients are buying more stuff from them.
So they're getting stickier.
Incredibly sticky. 98% of their top 50 clients now use more than one Concentrix solution. That locks in revenue for the future.
Okay, that brings us to the third, and I think most critical piece of this, the AI story, the proprietary IP. This is what everyone wants to see.
This is the whole thesis. And they're making real headway with their XSuite AI platform. After putting another $25 million into it this year, they hit break-even profitability on the platform.
That's a big milestone.
It's huge. And they exited the fourth quarter with an annualized AI revenue run rate of over $60 million.
60 million. Okay, but here's the number that really jumped out at me.
Let me guess. The attach rate.
The attach rate. More than 40% of their new business now includes some of their own proprietary technology. That's way ahead of what they expected.
It's a massive differentiator. In a world where everyone's just bolting on some third-party AI, Concentrix is selling their own tech stack to almost half their new clients.
But is $60 million in revenue enough? I mean, can that really compete with the R&D budgets of giants like Accenture?
That is the perfect question. And it leads right into their fourth strategic action, driving efficiencies to pay for all this growth. They have to fund it somehow.
So the classic save to invest model.
A bit more than that. They found close to $100 million in run rate savings on non-billable things, like old internal systems and duplicate offices.
And they're plowing that $100 million right back into the Executive platform and hiring the right people.
Exactly. It's a self-funding growth engine. And they gave some great examples of the kind of complex work this strategy is actually winning.
Yeah, I thought these case studies were really effective. They showed just how far they've moved beyond the call center model, like that big win with a global bank.
For a super complex investment banking back office process, no less. And it was a build, operate, transfer model.
Let's explain that. BOT. What does that mean for the listener?
It means Concentrix isn't just providing bodies. They are building the entire modern process from scratch using their tech. They operate it to make it super efficient, and then eventually they transfer the optimized system back to the bank.
So they're selling modernization as a service.
Yeah.
That's incredibly high margin and sticky.
Extremely. Then there was the win with a major electric car company. They're managing the company's whole digital footprint.
Content, customer warnings, everything. And feeding insights back to headquarters.
And my favorite was the European bank. They didn't even wait for a request. They went to the bank proactively and said, we can automate your entire claims intake process.
And that proactive pitch won the business.
It won the business, and because the automation was built in from day one, it came with much higher margins. That's the future.
Okay, so that's the how. Now let's talk about the when. When does this all really start to move the needle on the P&L? We need to talk about the 2026 outlook.
Yeah, the guidance was, let's call it conservative, but intentionally so.
What are the numbers?
For full year 2026, revenue between 9.93 and 10.18 billion. That implies, 1.5% to 3% growth. Non-GAAP EPS between 11.34 and 12.21.
That growth seems pretty modest, especially after a huge acquisition. But they were really clear about the known headwinds they built into that.
Very transparent. They're basically guiding for a 3% revenue drag on purpose, 1% from cutting that low-end work we talked about, and another 2% from helping clients optimize their own costs.
So they are choosing to walk away from some revenue now to get higher quality business later. That makes sense.
It's all about accelerating the margin improvement.
So what about that margin trajectory? They were at 12.7% non-GAAP operating margin in Q4. Where does it go from here?
Management said they expect sequential quarterly increases in operating income. But it's really a second half story for 2026.
Why the wait?
They admit the first half will still have some pressure. They're paying duplicate costs as they finish these big transformation projects. The real margin pop comes when those duplicate costs go away and the leverage from the big 2025 wins kicks in.
So a slow burn on margins, but the cash flow story, that is not a slow burn. That's a bonfire.
It's spectacular.
Yeah.
Full year 2025 adjusted free cash flow was a record $626 million, up 32%.
32%. That is powerful.
And they think it gets even better in 2026. They're guiding for $630 to $650 million in free cash flow. That predictable cash machine is what puts a solid floor under the stock.
And it gives them a ton of optionality with how they use that cash. And they are using it to send a very loud signal to the market.
They returned $258 million to shareholders last year. $169 million of that was share buybacks at an average price of around $47.
So they are putting their money where their mouth is.
Absolutely. And they committed to similar buyback levels in 2026. Management flat out said they see a stark disconnect between the stock price and the business fundamentals. They're also paying down debt, about $184 million last year.
Okay, so just to sum up, we've got the operational beat, the AI pivot, the conservative guidance, and this incredible free cash flow machine that management is using to buy back stock hand over fist. Which brings us to our favorite segment. This is purely speculative, and obviously this is not financial advice.
Never financial advice.
We call it, this is not financial advice. And we're going to use that FCF and buyback story to build an outrageous but plausible trade idea.
The whole thesis here is that management is being super conservative with their guidance, and the market is completely overlooking their ability to accelerate growth once these AI platforms really mature.
So we want to leverage management's own confidence that their stock is cheap. How do we play it?
The pitch is to get long CNXC, a leveraged long position, betting that the stock re-rates higher as margins recover.
Okay, but a leveraged long can be risky. How do we finance it?
We finance it by monetizing the market's pessimism. We would sell out of the money, long-dated put options at the same time.
All right, for listeners who aren't options gurus, what does selling an out-of-the-money put actually mean here?
It means you're selling insurance to someone else. You collect cash today, a premium, for agreeing to buy the stock at a much lower price in the future.
So you pick a strike price way below where it is now.
Exactly. Say somewhere around the historical support in the $35 range, maybe 6 months out. If the stock stays above 35, you just keep the cash you collected, and it helps pay for your long position.
And if it falls below 35?
Then you're forced to buy the stock at that low price. But our assumption is that the fundamental floor, that $630 million in free cash flow, the buybacks, the debt paydown, makes that a pretty attractive entry point anyway.
So you're basically using the company's own financial discipline as your safety net. You're getting paid to bet that the company won't completely fall apart.
Precisely. It's a way to play the recovery while taking advantage of that stark disconnect that management themselves called out.
So to wrap this whole deep dive up, this was not a simple beat or miss. This was really a progress report on a company in the middle of a painful but totally necessary pivot to higher value AI-driven services.
And they are validating that strategy with just incredible record-setting free cash flow.
Which leaves us with one final provocative thought for you to, chew on.
Given the early success of this egg wheat platform, 60 million run rate, 40% attach rate, how much bigger does that AI revenue number need to get before the market stops worrying about the near-term margin pressure and starts pricing in a return to mid-single-digit growth?
Or does the skepticism just win out? And will investors wait until they see the proof in the second half of 2026 before they're willing to reward the stock?
That waiting game is the whole question.
That's the billion-dollar question. And that's all the time we have for this deep dive. Thanks for tuning in. We'll see you next time.